All right, so it's been an interesting year. We're halfway through. At the start of the year, we highlighted a couple of different sectors that we liked. We talked about energy, we talked about materials, we talked about healthcare. Two of those three have done fairly well. Energy, mostly just because of obviously the Iran war, which is where we are now. And it looks like the war's kind of coming to an end, sort of, at least for the time being. But
today is.
Who the heck knows? So we're like a week into this thing ending. The thing that surprised me the most is that energy has retreated, oil prices at least have retreated back to where they were pre-war, which seems kind of make no sense. And the good news is energy stocks are still up like 20% on the year, which is also a little bit surprising, to be honest. But what do we think moving forward? What's everyone's beat on the Iran war and oil prices and where we are in this thing?
It's always funny to look back on from the beginning of the year or the beginning of the conflict until today, because if you pick three asset classes like high flying tech names, gold and energy, I would not have predicted at the beginning of the war that the tech names would be the leader by performance. Yeah. Gold has been down, and then the oil trade is basically back to where it started, which to me is interesting. It's a lot of volatility in that short period of time.
It really is. It spiked to, I think, oil got to about $120 a barrel at one point. And now, like you said, it's kind of back to where it was. Now, gas prices have not yet gotten there. Like, what does it mean for the average American?
Right.
And that's, I think, and obviously we haven't been as impacted probably as others that are impacted by the Strait. But I think gas prices as of, today or this week were right around, still the average gas price was like $4.04.
Which is probably where it was
right
a month and a half ago.
Exactly.
Yeah.
And, yesterday, so, today's the 25th. And so yesterday was actually the highest traffic of ships that went through the Strait. It's not really open or officially closed. It's just kind of like contested right now from what is kind of coming out. But they had about 78 ships that went through the Strait yesterday, which sounds really good. But normally the Strait's seeing like 100 to 150 ships per day. And so a lot of like these oil companies, they're still predicting that like the full pre-war oil won't realistically return to like 2027. And that's only if this peace deal honestly sticks over the next 60 days.
Which makes you wonder too, like, are oil prices low just because we've tapped into that strategic reserve?
Sure.
I mean, is that the only reason that we're back to 70, or is there more to it?
I think what I look back at, and I think you kind of touched on it, is where were we, what was the landscape going into the conflict? And pre-conflict, I think we were a bit of a glutton in oil. We had deep reserves. We're producing a ton of oil. JP Morgan's forecast was that we would end around $60 at the end of the year. So we were on a path to lower, cheaper oil. And so then we have to look at what's changed post-conflict. A couple things that I found that I thought were interesting was that, and I think my guess would be that this is a product of countries trying to build their reserves back up, but we're releasing oil from countries that we used to not buy from or allow other countries to buy from them. So now you've got access to some Russian oil, which we didn't have, and now we're allowing Iran to sell their oil. So I think that is the only way I can rationalize a lower price post-conflict, is that we've now introduced more supply. We've dipped into our reserves, but we've introduced supply from other countries that we weren't allowing to buy from people or buying from them.
Well, and it also makes you wonder, like, okay, if we get another flare up, because what are the odds that this peace still holds, or what are the odds that Iran doesn't start charging, tankers or whatever? Right. Like something weird will happen. This isn't just like, oh, great, Iran's got this under control. Yeah. But like, what happens to oil? Does it spike back at some point? And then furthermore, how do we refill the strategic petroleum reserve? It's at the lowest level since 1982 right now. And so we've drawn that down. We've got to repurchase a lot of oil. And you kind of wonder, is that just
does that bid that back up?
Right.
Yeah, that's a wonderful question.
So I guess the next question is, what does this mean for inflation? We got a PCE report today, and inflation came in, as hot as it's been. It's 4.1. And so anything with a 4 handle is well above the Fed's target, which has now been above that for 63 consecutive months dating back to COVID. We've seen, higher than average inflation. And so where does inflation go from here? Because it looked like inflation was heating up. I mean, that was kind of the consensus view. And maybe it still is, but I feel like the oil thing helps.
When we peel apart the inflation, we're kind of seeing that like the real drivers of the higher inflation is energy.
I mean, whenever the May report came out, it was 4.2% is what they were showing. But then when you look at the core inflation, it was only like 2.9%. And so, but that's because that's excluding energy and it's excluding food.
Right.
And so it doesn't look as bad as, so it's really, energy inflating everything right now. So
Makes sense. What's wild about what we hadn't talked about is the deflationary nature of AI, coupled with our inflationary current stance. Is there a possibility that somehow AI adds deflationary pressure to an inflationary environment and gets us kind of just plateaued?
Brings us back. Well, I think that's part of Kevin Warsh's idea because
Okay.
he's been the one preaching that AI is deflationary.
That's true. Yeah.
And so when he was going through all this, like Trump's picking him and all the talk, he was pointing to that as a rationale for rate cuts. So who knows? My hunch is AI is inflationary before it is deflationary because of all the CapEx spending and all the things and all the natural resources that goes in, which is why I like materials to start the year. And that's kind of played out okay. It's a little, it's done all right, but
And Warsh kind of has his hands tied in this instance. I mean, as dovish as he wants to be, he can't really because of the positioning of it. Lowering rates in this environment would be interesting.
Inflation factors into everything, but it also factors into the stock market a lot, and it can impact corporate earnings and other things. Couple that with the fact that we have pretty richly valued stocks as it is. Where do we think stocks are heading, and what do we feel about stock market valuations in general? Kirk, I know you did a lot of this last month in the blog.
Yeah, I mean, they're obviously at historic levels when you look at it from a price to earnings standpoint. We've kind of priced in perfection that everything that we're hoping AI does for the world is all going to play out exactly as we want it. I think most of us would agree that probably won't be the case, and that history tells us that no matter how transformative something is, it doesn't play out the way we want it, and it doesn't always mean that it's a great investment or a great return for these companies that are investing so heavily. So that's something that we're definitely monitoring, talking about every day. And the rates and the cycle for rates play a huge role because obviously higher rates are not great for those companies that are borrowing and trying to make big investment in the future.
So Ford S&P 500 earnings right now are at like 22 times, okay, earnings. Current yield, treasury rates, somewhere in 4.3 to 4.5%. The only other time that has happened, not to be a major downer, and y'all can guess what it was the dot-com era, right? So, it's historically overvalued. Now, you could argue, and I think this is the argument, is that AI and some of those things that come along with it are driving up those valuations, but there's also productivity and other things that go along with it that maybe don't inflate it. So, pretty interesting point in time, though.
I think more than anything, that speaks to investors' appetite for risk right now.
Yeah.
And the question becomes, when will they have had enough? And whenever investors decide they've had enough risk, they've had enough of buying things at astronomical valuations, that's whenever people have to answer some questions and things will get interesting.
As yields where they are, and you talked about it. I mean, we're kind of in that. I think the retail investor probably has more of an appetite for risk at this point, but at some point, whether it's the retail investor or the institutional investor, they're going to look at those yields and say, "Hey, am I really willing to take that much more risk for something that I could basically get?" And certainly in a much more conservative or much more, to use the term, safe approach.
Ironically, it comes back to COVID again. When did retail investing become popular and gamified and casinoified? And it was COVID. And you have just this onslaught that the market's really never seen of retail investors that probably don't know the valuations of the companies that they're buying. And they're doing it at enough scale to actually move the needle probably for the first time in history.
So, do you guys remember during COVID when there were just new businesses? Like your cousin would just have like a new business and just have a new idea, and there was so much money flowing around that people just had these ideas and were forming new businesses. And you can track that using some federal data, and you track it using, the employee identification numbers, the EINs. So if you look at 2020, it exploded. The amount of EINs that people applied for to become new businesses just skyrocketed. Okay, and that makes sense because everybody's sitting at home having new ideas. It was just kind of the culture at the time. If you fast forward to today, it plateaued for a little while, but now it has picked back up and is reaching the same type of momentum that we saw in COVID. Really interesting.
And the other difference to COVID is the lack of free money. The money was free. It was easy to do it, and money is going to get more expensive as rates go up. So that's an interesting caveat to that point.
Speaking of your SpaceX discussion, they're a non-profitable company right now. And we're paying 90 times revenue for a company that makes no money. We saw that in COVID with the Goldman Sachs non-profitable index, which is an index that just tracks companies that are not profitable, rallied some insane amount during COVID. And we're seeing that again right now, that we're seeing this massive rally because if you think about it, the minute you have earnings, then you have something of value and you can say, oh man, that's too expensive for those earnings. But if you don't have earnings, that's the sweet spot because it's all about high
Pre-revenue, right?
Pre-revenue.
That's right. And it really makes me wonder is every AI stock I'm looking at, and I think it's honest to ask this question, is every stock I'm looking at Peloton? Right. Is this the next Peloton? Where we just thought that Peloton was going to be in every ubiquitous, it was going to remain, and it is not. Is it just a one shot? So that's the tough part about valuing right now.
The areas I think that are the most overvalued are all around the AI build out. And that may continue for a while because we're still pumping a ton of money in, but at this point it feels like the driver for the stock market is AI. You can't do anything without talking about AI.
It's still a big Mag 7 thing too. Even though we're kind of expanded past that a little bit, I think I saw Mag 7 is 30 to 35 times earnings at this point, forward earnings. The S&P 493 is at 17 to 18 times forward earnings. Which is, does show you there are pockets where the valuation, honestly, a large portion of the S&P is maybe more fairly valued relative to historical values.
Well, on that same note, we've talked a lot about how AI is in semiconductors really just driven the market this year, which just leads to how much the war did not really affect the market as a whole this year. Because when this first happened, we obviously had a little bit of volatility there, but I'm a little shocked coming from February when this first started to now that the market's mostly shrugged this off, other than the energy sector. And I think that just kind of goes to the S&P 500 is not the economy, and that it's just such a top weighted these mega companies driving it with AI, and I feel like this has just paired so much to just counteract everything going on in Iran right now. So, which I really didn't think we would have the numbers that we have in the market based off what was going on.
So I saw something the other day that the stock valuation dispersion is the highest that it's been. In other words, it is a stock picker's market. To your point about the S&P 493 versus the S&P 7, you get huge valuation differentials in different sectors and different stocks and different things. I think the name of the game is to pick your spots, be selective. I don't really think this is a time where you just close your eyes and own the broad index. That has worked. That has worked tremendously well in the last 15 years. But there does come a time where you see the winners and the losers and you see that bifurcation. And at our start of the year, we picked three sectors. We picked healthcare, we picked energy, we picked materials. Healthcare's done pretty cruddy. It's underperformed the market, but I think there's still value there. And if I'm looking at the second half of the year and I'm saying what's not overvalued and where can we go, I think healthcare is an area that interests me still, even though it has lagged. And I think there's other areas of the market. I think there's pockets. I think software is interesting. Software has been thrown out maybe with the bathwater. AI is going to replace every software company. I think there's pockets. I think you can be selective with opportunities and pick things. And so that's kind of my thought on how to play it. I don't have a bold call, but I think just avoiding the areas that look the most expensive and finding other pockets is probably the way to go.
It'll be an interesting back half of the year.
It will.
Mm-hmm.